Time once again to check on the latest earnings trends with Zacks Director of Equity Research, Dirk Van Dyke. Well, Dirk, as we sit here close to the end of earnings season, we're about in the middle right now, but the end is not far behind. Is corporate access to credit improving at all?
Yeah, I mean, the credit market indicators, if you look at like the spread between high quality and low quality commercial paper, the A2P2 spread, that's come way down. The TED spread is about back to not totally normal, but where it was last summer, not at the extreme levels that we saw, after the collapse of Lehman in the fall. So we're not totally out of the woods, but most of the credit indicators are looking better. I mean, banks are still being cautious in that, we had the Fed come out with its survey of lending. Right. They're definitely still very tight, a little bit less so than they were.
Let's talk about bank earnings. What do you think the results of the stress tests, once they're in officially, are going to do to impact bank earnings here going forward?
Well, I mean, one of the most dramatic impacts will be for those, what's now rumored to be 10 of the 19 that are going to have to raise more capital. Mm-hmm. It will affect their earnings per share rather dramatically because they're going to be forced to raise more equity capital. For the banks that haven't been stress tested, there will only be indirect effects on that. By and large, you're going to see the regulators going forward wanting the banks to hold more capital, which will mean there's more ROE for the return. ROE will force return on equity lower for the banks over the long term. All
right, give me the bottom line on Q1. Once the dust settles, where can we see earnings at?
We're probably going to see earnings down about 27.5%.
Better than you thought?
Yeah, it's coming in a little bit better, but again, you got to sort of look at things ex the financials, and then things aren't looking all that good, and the financials are a bit flaky, their earnings.
And you're saying that healthcare, tech, discretionary, all showing a good amount of positive surprises.
Yeah, and then we're also seeing that translate into upward estimate revisions. I mean, we now have half of all the sectors with more estimate increases than cuts, which is a dramatic turnaround. Overall, right now, we're seeing about 3 cuts for every 2 increases. Mm-hmm. But technology in particular, you're seeing a lot of estimate increases, particularly amongst the chip stocks. That's a very hopeful sign. Both of the consumer sectors have more positive increases than cuts.
Utilities, you tell us, are doing pretty well.
Utilities are also coming through, particularly on the earnings front. I think right there with the utilities is that generally utilities have their rates set once a year. A year ago, we had really high energy costs. They got some of that passed through. Right. Energy costs have fallen. Lo and behold, the utilities are doing okay.
But oil's going back up, so might we see those energy earnings back up too?
Yeah, I mean, so far we haven't seen that in the estimates on the energy sector. The energy continues to get pretty slammed by estimate cuts right now, and although even though some of the companies have come through with fairly decent earnings, it's sort of down at the bottom of the pack. Also, the interesting thing is that even though the financials came out with these better than expected earnings, mm-hmm. we're not seeing a lot of estimate increases amongst the financials.
What's your read on Q2?
Q2 is probably going to look a lot like Q1. Right now, we're looking at a decline of 31.9%. In terms of total net income. This sort of little blip from the financials is expected to to reverse, and we're going to be back to ugly earnings, or at least that's what the analysts are expecting in the second quarter. By and large, you're going to be looking at the more defensive stocks, sectors, the healthcare and the consumer staples, holding up better, maybe eking out very small year-over-year gains in total net income. But
so you're looking for recovery in earnings late this year into next?
Well, in the fourth quarter, we start getting really easy comps. So we may see a recovery in there. Third quarter, I think the economy is still going to be really soft. We still have unemployment shooting up. So I'm not.
I'll take that as a no.
It's a no. But the fourth quarter, we may from the easy comps.
All right. If you want to take a look at Dirk's updated scorecard, just go right to the text version of his earnings trends piece for this most current week. It's housed on Zacks.com. You scroll down the page until you see the headline next to Dirk's picture, and it'll take you right to it when you click on it. With Dirk Van Dyke, I'm Terry Ruffalo.